Today, I'm going to tell you the number one tax write-off for real estate investors. Spoiler alert, it's depreciation. And today, we're going to break down depreciation and how real estate investors can use it to save thousands of dollars in taxes. What's up, boss friends? It's your girl, Jessi Nicolette, realtor and accountant in Atlanta, Georgia area. Thank you for tuning in. If you're new to the channel, we talk real estate, building wealth, and living our best lives. So if you're down to talk, go ahead and hit the subscribe button and make sure to turn on your notifications because you do not want to miss what we have in store. Please do me a favor and share this video so we can spread this information and help grow the channel. Now, before we start, I want you to know that I am a licensed realtor in the Atlanta metropolitan area, and I would love to earn your business. So if you're interested, please click the link below to book a free consultation with me today. With that being said, let's talk. Real estate is one of the most tax-advantaged investment tools. The federal and state government structure tax laws incentivize specific behaviors, and real estate ownership is one of the most important behaviors they want to incentivize taxpayers to do, which makes sense, right? The more homes bought in a certain area means more people are living in that area, which then also means the economy in that area is being stimulated and more tax dollars are being collected. The government wants you to invest in real estate because it means more tax revenue for them. And the depreciation write-off is an incentive for real estate investors to take advantage of some huge tax benefits. This cost is called depreciation. For non-real estate assets, like for a car example, it loses its value over time and becomes worthless, right? But the same is not true for real estate. Depreciation assumes that an asset will lose its value, but as we all know, real estate actually tends to appreciate in value over time. So there's this write-off for depreciation expense. It's a huge incentive for real estate investors, and here's how it goes. The formula is the cost of the property divided by its useful life, right? First, the cost of the property should not include the land cost. Land is not considered depreciable property. So let's take that down. Land cannot be worn down or broke apart. Therefore, it's not included in determining depreciation. And two, the IRS already defines what the useful life of real estate property is for residential property. Like a house, the useful life for a house is 27 years versus a commercial property, which is 39 years. It's assumed that a home that someone lives in would probably experience more wear and tear than a commercial office building. This is why commercial real estate is deemed to have a longer useful life. For example, you bought a residential property for $750,000. The land cost is included in this amount and is worth $150,000. This means the house itself is worth $600,000 or the $750,000 minus the $150,000. You then take the $600,000 with the cost of the property and divide it by the useful life of the property, which is residential, 27 and a half years, and the annual depreciation is $21,818. So you didn't actually pay out in cash the $21,818, but got the write-off for it. And you get that write-off every single year for 27 and a half years or till you sell the property. This is called straight line depreciation, assuming no other expenses. So if this property gives you $25,000 in rental income for the year, you would normally have to pay tax on that $25,000, and if your tax rate is 25%, it would mean $6,250 in taxes. But with depreciation, you now only have to pay on $6,818, which comes from the $25,000 in rental income minus your depreciation expense of $18,000. Okay, stay with me now, y'all. This is my accounting brain talking now. Remember I told you I'm a realtor, but I'm also an accountant, okay? So assuming the same tax rate of 25%, you will only have to pay $1,705 in taxes compared to the $6,250. That's about $4,500 saved in taxes, y'all. So as you can see, real estate depreciation acts as a tax shield and reduces your taxable income, meaning you get to offset that depreciation expense with the rental income that you earn. And this is going to result in thousands of dollars saved in taxes. As you just saw, you know what you could do with those tax savings, right? Invest in more real estate and do the same thing with multiple properties. Now, I know you might be thinking, okay, 27 and a half years and then 39 years, that's a long time to depreciate a piece of property, right? And you're right. So it will be even more beneficial to take the depreciation in earlier years, especially if you only plan to keep the property for 5 to 7 years. I have another strategy that you could take advantage of as well as a real estate investor if you want to accelerate or speed up your depreciation deduction, and this is called cost segregation. Now, with cost segregation, you can take bits and pieces of the property, like the roof or the cabinets, and depreciate the cost of those items over a shorter period of time. Now, cost segregation is a little more complicated, y'all, so I advise you kids do not try this at home without a qualified CPA. And if you are in need of one, we have a great team at JSM Financial Services. So click the link below to set up a consultation if you need a bookkeeper or a CPA on your team. Now, there is something you should be aware of as it relates to real estate depreciation, and that is a depreciation recapture. When you take depreciation expense as a deduction every year, you're reducing your basis in that property. If you paid $500,000 for the property and depreciated for 1 year, your new basis or cost of the property is $481,818, or $500,000 minus the $18,182 in depreciation. Now, the true value of the property is obviously not going down, but for tax purposes, it technically is, okay? I hope this information on how depreciation works and how it can actually save you money when you're investing in property helps. Remember, if you're interested in building wealth, creating a legacy, or generating passive income, investing in real estate is a great starting point. And I would love to be a part of your journey. If you need help buying or selling in the Atlanta metropolitan area, please click the link to schedule a free consultation with me today. That's all I have for you guys today. Thank you so much for tuning in. Please remember to subscribe, hit your notification button, and share this information with all of your boss friends. I am Jessi Nicolette, and I'm signing out.